This one's actually quite important. We've received, I think, about a half dozen questions on it from our clients because it does impact a couple popular Canadian traded stocks, and it's something which is quite confusing, especially on a service level if you aren't familiar with taxation, especially, and even then, it's quite a unique situation we're dealing with here. But yeah, we can get into it. So many people have received notifications from their brokers. So I know Questrade has issued them interactive brokers. I didn't get one from TD myself, but I think a couple people have. So quite a few brokers have been issuing these statements saying you're now going to have to pay a 10% withholding tax on these specific U.S. securities, well, U.S. originated securities, but they actually trade on Canadian exchanges, which is quite confusing. Why would the U.S. be taxing a Canadian exchange? But it actually can happen, and they're free to do it. And I'll go into why. So, what is this withholding tax? First of all, and really, what companies is it going to impact? The relevant tax code is Partnership Withholding Tax, or IRC Section 1446F. Quite a mouthful to say the least, but it's U.S. tax code, so what do you expect? The withholding tax only applies to non-U.S. investors, so for any U.S. listeners, you're safe. You don't really have to worry about this, assuming you're a U.S. taxpayer. If you're paying your tax in the U.S. and that's your country of origin as far as tax purposes goes, there you go. You don't have to worry about it. But this withholding tax is 10% of total proceeds, not the profit, not the gains, 10% of total proceeds, which is quite harsh to say the least. So an example of this, let's say you sell 100 shares of a security, doesn't matter what in this case, for $10 each, you receive $1,000 normally. But of that $1,000, if this withholding tax does apply, the IRS would take 10%, leaving you with $900. And like I said, this isn't applying to gains like other taxes, which we see. It applies to the total receipt. So even if you lost money, if you initially bought it at $20 and it fell to that $10, you'd still owe the 10%. You'd still be paying that $100 in tax. So initially you would have had the $2,000. It went down to $1,000. You owe another 10% on that. So you're only getting $900 back. You lost $1,100. So that tax is quite penalizing. And it obviously goes in reverse. So if it went up to like $10,000, you'd be owing $1,000. That is harsh compared to every other tax which you normally encounter. So moving to the securities it really impacts. As the name implies, it affects partnerships, which is a type of business structure. A partnership is simply a relationship in two or more parties that trade or do business, with each party receiving a share or profits and losses. But this is commonly seen in like law firms, in accounting firms, stuff like that. But in this case, it's specifically publicly traded partnerships, which you don't see yourself normally as a partner, but you're buying effectively stock in this partnership. I'm not going to go too far into the structure, but that's really all you need to know for this. And unfortunately, like as the corporate structure always is, it's not exactly clear. Some real estate investment trusts, for example, or REITs is commonly called, in the name implies it's a trust, not a partnership, which is a different corporate structure, but it even in fact affects these REITs. So due to the complexity of overall corporate structures, some REITs have subsidiaries that are partnerships, and that's why they're impacted. So you might be buying a stock or a unit in the parent company, but if the subsidiary, which is located in the US, is a partnership, and you indirectly hold a holding in this, even though you might not be purchasing that holding, you could be impacted. So a common security we've been asked about is Brookfield Infrastructure, LP, and LP is a limited partnership. There's your partnership. So if you see that symbol and it has operations in the US, you might want to check it out, but that's not absolute. As I was saying above, it depends on the exact corporate structure. So symbol BIP.un on the TSX is Brookfield Infrastructure. As the name suggests, it's a partnership, and it has exposure to the US, meeting the criteria for potentially needing the withholding. But as the next complexity arises, as taxes always love to be extremely simple and understandable, like this case, it is exempt. So why is it exempt? It's exempt, has no direct operations, the parent company in the US, but a subsidiary does. So all of Brookfield's holdings, which you'll be purchasing the parent company, which is BIP. It has its subsidiary Brookfield US Holdings, and that's a corporation. So since it's a corporation, it doesn't actually apply to it. And since technically, this is where the legal standing of it being its own separate entity, technically, BIP doesn't have operations with the US or in the US. So it can be exempt. But as a cautionary statement, I will say the BIP accounting, I would assume, they need to continuously apply for the exemption. So if for some reason, a significant oversight to say the least, they didn't apply for this, they could actually still get the 10% withholding tax applied to them. That's very unlikely, but it would be a massive oversight and it is potential. And I'm waiting for the case 5 or 6 years down the line where some accounting person gets fired and no one applies for it. I'm waiting for that day. Just don't hope you're holding that stock if it does occur. So, without doing really any in-depth analysis into corporate structure, the easiest way to really find out is by checking a list from a broker. I'll include one from Interactive Brokers in the description. I think CIBC has issued some. But the issue with these is they're not up to date. Sometimes I've found some mistakes in the IPKR one. It's really just, it's good for a potential issue. So then what you want to do after that is Google or go to the company website. So if you're Googling, search the company's name, then 1446 tax withholding alongside with it. And likely if it applies to it, it will come up on the company website or on Google. It'll also be quite quick. But obviously, if you're really concerned, if you're a client of ours, you can contact us. Or if you're not, then become a client first of all. But if not, you'll have to acquire with some other third-party firm. I hope this information really helps those who are concerned with their holdings or potential holdings. We've had a few people say, should I buy this stock? It's coming up as this withholding tax can apply to it. And in many of those cases, they've been exempt or it doesn't apply at all. But yeah, I don't know if you guys have any comments on that.
No, it's a good breakdown, and Brett is our resident expert. Well, I use the term expert lightly, no offense to Brett, but
Calm down.
he's the
calm
one
down.
who is the most knowledgeable on this taxation in the company. So if you're a client and you email us about a particular stock, you'll probably be hearing from Brett. But one thing that I want to make clear is that we do get questions about taxation from time to time, and we are not tax experts. So when I said that Brett is not an expert, I mean that in a literal sense. An expert is a tax attorney or a tax accountant, and we can only give just general information based on what we know. But the caveat there is that we are not experts in any way in taxation. It's a very complicated field. It changes all the time. There's a lot of gray zone. It's not necessarily black and white. So we do our best to try and provide some information on how things work, but do not rely on our taxation advice.